Hello and welcome to the latest episode of Insurance COVID Cast, brought to you by Insurance Post and Insurance Age. And today we have the first in a series of specials linked with the Insurance Post and Sona Insurtech 100 ranking, starting at the very top with the number one Insurtech, Lemonade. Now I'm delighted to say I have a co-host today in Sonar CEO Matt Connolly, and also joining us from Lemonade we have its CEO and co-founder Daniel Scheiber. Welcome both of you.
Good morning.
Right. So Daniel, if I can just start by just asking to, if you could perhaps give us some idea about the latest numbers in terms of policyholders and premium Lemonade. And I know 3 years ago when we spoke, you mentioned about 90% of your policyholders were first-time buyers. Is that still the case?
Sure, good to be with you. So the company has ballpark 800,000 customers today. Ballpark $150 million of gross written premium. So those are kind of rough and ready numbers, but they give you a good sense. And yes, remarkably, as best we can tell, still about 90% of our customers are coming to us for the first time. So we have an onboarding question where we ask, Maya, the bot, asks if you'd like any help in moving from another policy. Are you switching? Are you not? And about 90% of our customers get asked that question, and about 90% of those who get asked it say, I'm good. So, yeah, it does seem like we're over-indexing pretty hard on first-time buyers of insurance.
Very cool. And I'm assuming that's going to be very much true with the German market and also the Dutch. A question that I had was regarding the Dutch, so the launch into the Netherlands, which April time, if I'm right in saying, pretty much soon after lockdown hit. How did that affect you guys?
We launched entirely remotely. So we do have a team in Amsterdam. We have a small team in Holland. That's kind of our European headquarters. So when we launched Germany, and to date we still have 0 employees on the ground in Germany. In Holland, we did have people on the ground, but it made no difference because they were all quarantined at home, so they might as well have been on Mars for all the difference that made. And it's been really interesting and surprising to us how much business has been able to operate uninterrupted, including the launch in Holland, which happened while all of our offices were under lockdown. But beyond that, it's been a pleasant surprise to see that the business has remained really strong. Customers and customer demand has remained really strong, and all of our teams have been able to operate remotely with no real business interruption at all. So I'm feeling pretty lucky about the way that played out.
Good, well done. And then for the forward strategy, so rewinding a little bit, we talked about sort of Germany 2019, Netherlands 2020. What was it about those particular territories? What were the market conditions? How were the market conditions set that made them attractive for you guys? And what's next?
Germany is the largest insurance market in Europe. It's also one that is still very much dominated by traditional broker-based businesses. And so being a little bit contrary, we like the idea of going into markets that are still very traditional. And we think that give us kind of the most pronounced difference between what consumers are used to and what we have to offer. And that's, of course, not true across Europe. In the UK, that's probably the most advanced and most digital market across Europe. So that has advantages because consumers are familiar with that mode of interaction, but it has disadvantages because the competition is more pronounced in that sense. So that's why we went to Germany first. Holland was second for a couple of reasons. One, we really liked the demographic there in the early adopters of technology. The downside of Germany is that it's a fairly conservative market, fairly traditional market. And we liked the alternative dynamics of Holland, where it is still dominated by traditional players, but the readiness of consumers there to adopt technology and to look favorably upon American brands is perhaps different to what it is in Germany. So that's one dimension. The other one is that we are regulated by the Dutch regulators. And we committed to them that while we wouldn't launch in Holland first, we would launch in Holland as soon thereafter as it was practicable. So those two things coincided for us.
Super interesting. And so the second half of my question, the other territories across Europe that might be of interest to you. So you mentioned the UK.
Yes, so we do think of our ambitions as expansive, both in terms of product offering and in terms of geography. Europe differs from America in two ways, one good and one bad from our perspective. The good is that it's a single license. We tend, particularly people outside of America, tend to think of America as somewhat uniform or monolithic, but from our perspective, it's 51 different jurisdictions, and each one has to grant a license independently and approve the rates and the forms independently. It's incredibly cumbersome. Europe, for all its differences, is a single regulatory environment, and one license, the Dutch license, basically brings 450 million people under license for us. On the other hand, there are language differences, and there are local legal differences, and there are competitive dynamics that differ from territory to territory. So it's a kind of mirror image of what we experienced in America, where the market there is relatively uniform, but the regulation is incredibly fragmented. Europe is the other way around. So we do plan to go and expand in Europe quite significantly. We're not pre-announcing countries right now, but the broad ambition stands.
I think on your website there's a drop down where you can, be alerted when you enter, and I think it had most European countries bar a few. I think Russia, Turkey, and Ukraine were three. I saw the words on there, but there was a great spread. Can I ask Daniel? I know that one of the headlines that kind of was attracted by your entry into Germany was the dispute over a little colour called Magenta with Deutsche Telekom. Can you give us any update on that?
Yeah, with pleasure. By the way, the Russia-Turkey thing is that those aren't under the same license as the... Nothing against those countries per se. Certainly nothing I'd want to discuss on this show. Coming back to your question about Magenta. The dispute lives strong. So we are embroiled in legal battles. We decided once Deutsche Telekom decided that they kind of can't hack a insurance startup using the color pink. We posed too big a risk, an existential risk to Deutsche Telekom. It's really it's such a silly story. It's been amazing to see how a company as large and as respected as Deutsche Telekom has taken the battle to such extremes. I saw there was a Kickstarter campaign by some company wanting to create a smartwatch, and they used the color pink in their ads. They took legal action against these poor people. There was an outfit of some 10 people, I think in Bristol it was, where they're doing servicing of Mac computers for educational institutions. They served them with a cease and desist. And the list just goes on. Blogs in America have been served with cease and desist, stuff that's unrelated. If somebody came into Europe with a big color orange and they were a mobile operator, you'd understand why orange would have a problem with that. But a smartwatch maker who uses the color orange, surely not. And the same has to be true with pink. The idea that my printer here has 3 colors. One of them is magenta, and that is owned by Deutsche Telekom. Just is too silly for words. So having secured a court injunction against us in Germany, we obviously abided by the court injunction, and we took down Magenta, and our website in Germany is red. But having complied with the court directive, we decided that this is just bully tactics. It really is. This is just going much too far. They're not in the insurance space. We're not in the mobile operator space. How wide a berth do we have to give these guys before somebody's allowed to use the color pink? So we are doing a couple of things. We challenged, they have a pan-European trademark, and we are challenging that. We've gone to court to argue that they should not have that trademark, that it has gone too far. And in fact, the law, the precedent has changed meaningfully in recent years. There was an important KitKat decision by the European Court that said that the shape of the KitKat couldn't be protected, the shape in that case, if it wasn't familiar in every country, every jurisdiction within the EU. And it wasn't, and they lost that trademark. Surely the color pink isn't associated with Deutsche Telekom in every country in the EU. So on that basis, we are challenging their pan-European trademark. They tried a bunch of bureaucratic things to get that delayed. Somebody else had challenged them on this 10 years ago, and they managed to get it embroiled in legal nonsense for 10 years. But it looks like we've been able to overcome those hurdles, and we'll have our day in court soon. And in parallel, we've started issuing challenges to their trademarks on a country-by-country basis. So we've challenged it in the German courts, they are challenging it in the French courts. We'll see if we can have some fun along the way.
So, how close are you then to offering insurance close to home in the US, in every state now in the US?
We are pretty close. So we have licenses now in states that comprise about 90% of the US population. We're not live in each of those states for various reasons. The launching lags a little bit. It's a dual step process in the US. You need a license and then you need to get your rates and forms approved. So there is a bit of a time lag, but we are live in states that comprise 3/4 of the US population, and that's growing all the time. The only sizable state that we haven't launched in is Florida, and I think that's pretty imminent. So we're feeling pretty good about closing out the final gap.
Daniel, I've got a question. I remember back in 2016, I think your chatbot Jim made a bit of a record speedy claim handle, and that certainly sort of put Lemonade on the map as far as I was concerned. We'd been looking at the landscape, following the business, but that was a real standout moment. And from then on, every client interaction we had, every presentation that we saw, it was always referencing you guys. So that's classically sort of famous in the Insurtech journey, I guess. Are there any other bits of innovation that you guys have pushed out that haven't been picked up or that haven't been covered that you're really proud of, and that you would like to have shared?
There are a bunch that we're proud of and happy to share them. I think they don't have the same dramatic moment of somebody's park coat being paid for in 3 seconds, and that was a seminal moment for us, and I guess for the Insurtech more broadly. And that's happening. That's become pedestrian in the best sense of the word. It was exotic back then, and now we do it many, many times a day or an hour, and it's happening the whole time. So that's fabulous. There are 2 or 3 things that I think you might find interesting, even if they're not quite as photogenic, so to speak. One is the power of all of the integrated technologies that we've built to lower our loss ratio. So back in 2017, early 2017, we had a horrendously high loss ratio. It was 300 or something. In the last quarter, it was down to 72. I looked for the last year published, you look at the top 20 insurance companies and homeowners insurance in America, the average was 82. Which means over the course of the last couple of years, we've just seen this precipitous decline in loss ratio, consistently without a single quarter reversing that trend, to the point that we're now at par, if not advanced relative to the incumbents. And we've been in market 3.5 years. And we've done that. You've seen that kind of shaving almost 300 points, 296 points off our loss ratio, while we were growing at 450% compounded annual growth rate. If you just juxtapose those 2 trends, you realize that something is happening that flies in the face of conventional thinking. This defies insurance orthodoxy, because the orthodox position is, if it grows like a weed, it probably is. And large insurance companies talk about lowering their loss ratio, they talk about shrinking to excellence. And there is this conventional received wisdom that growing fast comes at the cost of quality. And I think that makes sense if you're built on a human substrate. Certainly being overwhelmed means that people cut corners, they do a less good job, and they don't underwrite quite as well, and quality would pay the price. I think the deep change, and this is a much deeper change in terms of Insurtech than paying claims in 3 seconds, the deep change is that we're showing what can happen when you're built on a digital substrate. And you actually define the gravitational pulls that govern insurance up until this point. So suddenly you see that when you build the system using 21st century methodologies, then masses of data and rapid growth aren't an impediment to increasing quality and good results. They are the enabler of it. It's flipped that conventional thinking on its head. And I think that draws out what I do think is a real vision or a crisis moment, although it will be stretched over so many years that people won't feel it as a crisis moment. which is to say that insurance companies have lost dominion over data. Way back to, from the coffee shop of Lloyd's in London in the 1600s, insurance has co-evolved together with statistics and data. During that same time that Lloyd's was creating his coffee shop, Bernoulli was coming up with the law of large numbers, and basic building blocks of probability theory came into place, and the two co-evolved, as I say, over the last 300 years. And if at any point during that time I had asked you, who are the bastions of the world's data and who is home to its finest statisticians, you'd have said an insurance company. And I think even as recently as the 90s, if I asked you that question, you'd have said an insurance company. And if I asked you that question today, it wouldn't even occur to you to say an insurance company. You'll list Google and Twitter and Facebook and all of Silicon Valley. So insurance has lost dominion over the core building blocks of insurance, and they've lost that to tech. And what I think the example that I just gave with these juxtaposed graphs suggests is that there is a way to claw it back. If you rebuild insurance from the ground up on a digital substrate, free of all the legacy that encumbers incumbents, you can get to an entirely new mode of underwriting and pricing risk, which is obviously the very core of insurance. And 2 or 3 years ago, when we published that blog post about AI Jim, if you asked insurance executives about Lemonade, I think they would pass the backhanded compliment of saying they've got a cool app and they're good at PR.
Yeah.
And the implication would be, but they don't get the core of insurance. They don't really get insurance. And I think what we're seeing is that technology can outperform expertise. I think this is true broadly. Moneyball and baseball and all different places where technology and big data is outperforming expertise. Wine tasting, it's amazing how many different fields where we thought we're depending on human experts, we're seeing that big data and machine learning can outperform. But that's, I think, what you're beginning to see in some of Lemonade's results, which is that 3 years later, zoom forward from that blog post about Jim, and what you're seeing is that we're actually outperforming at the 90% of the iceberg that is submerged. Forget the 10% that's above water. It's the fundamentals, it's the machinery of insurance that is being transformed in powerful ways. And that ultimately is what gives Insurtech its heft. And it's that 90% of the iceberg that ultimately sinks the Titanic.
But if I'm right in saying also the 10%, look at the Maya stats. So that's your customer satisfaction sort of front end sort of ticket service. So that's outperforming in a relative sense. So whilst the tickets are rising, your satisfaction is also going up, but Maya's handling the large part of all of those tickets, right? So is that sort of chatbots good, humans bad? It can't be as simple as that.
No, it isn't as simple as that. But I do think that what you're seeing is that building a company on a digital substrate allows you to do this kind of double whammy of lowering costs while increasing customer satisfaction. So this isn't the low-cost airline where you have to pay for your peanuts. This is something where this is Uber, where you end up with a better experience, real-time information, click of a button, and lower costs. And we see this, it is only technology that can deliver that. Dramatically lower costs, not at the expense of customer satisfaction, but to the delight of customers. One of the things that we've tried to do, and Shai, my co-founder, is really a thought leader on a global basis around this, is how to meld bots and humans. Because so many of our interactions do that so poorly. You call up to change your flight. I fly United Airlines a lot, and anytime I call, I have to feign an American accent for them to possibly understand what I'm saying, and you're pulling out your hand, you're like, just get a human on the phone. And it was nice, a couple of years ago, somebody did a review of Lemonade, and they said that Maya had much more personality than the person she spoke to at Liberty Mutual. So
how she handle the accents?
Yeah.
She do okay?
It's just fine. But I think what we try to do is only use technology in places where it can outperform humans and not use it indiscriminately. So yes, AI Jim will pay 1/3 of the claims instantaneously, but 2/3 of our claims will have human intervention. Maya will answer 1/3 of all customer inquiries instantaneously without any human intervention. And when she knows what she's doing, that's amazing, because you wrote in, I'd like to add my spouse to my policy. And she said, sure, what's her name? and did it for you, you got instantaneous response, you're happy. But if she hasn't got an incredibly high level of confidence that she both understands the question and knows how to answer it, it gets passed right through to a human. And you don't know the difference. You just ask a question and you got an answer. So taking the time to think deeply about what are the things where technology outperforms humans and what are things it isn't, and create a seamless integration that weaves human and bot is something that Shai was quite insistent on from day one, and I think it shows.
I suppose, Daniel, obviously you talked about, the handling of the Parker claim in 3 seconds. I know one area of diversification that's been talked about recently with Lemonade is pet insurance. And of course, I think people love their pets more than they love their Parkers, no matter how expensive they are. But why enter pet, and what other sectors are you possibly thinking about launching into?
Yeah, they do love their pets a lot more than their Parkers. And it's been, over the last few decades, I guess, but it's become accelerated, if anything. There's been a deep difference or change in how people view pets than how they were once viewed. People don't view pets as property. They think of themselves as pet parents. They walk after their dog in the street with a bag and pick up their poo. You don't do that for your property. And pet insurance began life as horse insurance, actually, in the 19th century. And really, horse insurance was an early version of car insurance. So it's born of that kind of property and casualty perspective, and a lot of policies and the way people insure pets has been, therefore, increasingly at odds with how they think of their pets. And this manifests very powerfully in the numbers in the United States. In the UK, pet insurance is pretty well penetrated and common. I think something like 40 to 50% of pet owners have pet insurance. In the US, it's less than 2%. So this is a woefully underserved sector. While we know that about 2/3 of our customers have pets. So we thought this is a great product, good fit to our existing customer base. And the way we think about new products, and pet is the first foray beyond homeowners, but it's not our last. So a bit like the European countries, it's not a question of why this, it's a question of why this first. And we just felt that this was an area, again, being contrary, where it's underserved, it's not being given the kind of love and attention that the potential represents, and that it's a great fit for our customers. And we do try to think in a customer-centric way. So we sell condo insurance, apartment insurance, and you could say, oh, well, then why don't you just do commercial real estate insurance, because you're insuring all the apartments in the building, now insure the building at large. And that makes sense from one perspective, but not from a customer-centric perspective, because the customer who's insured with you in that apartment block isn't thinking about who's insuring the building at large. That's an entirely different customer with a different set of needs. They are thinking about the poodle around their ankles. So once you think in a customer-centric way, and you think about, well, with catering to these needs of our customers, which needs are under-catered for? Where are we forcing our customers to go uninsured or to go insure with other insurance companies? And that's really how we prioritize. And just tying this back to an earlier question you asked about the 90% customers who are first-time buyers of insurance. One of the fabulous things that we're seeing is that we are competing with non-consumption. That's what that implies. Our customers are not being taken from someone else. The entire insurance industry seems to be predicated on the I switch and I saved proposition, and we're not playing that game, we're not playing that sport. But what that also means is that we therefore have a bit of an opportunity and a responsibility to grow with our customers as their needs grow. So an easy progression is they are renters and then they go and buy their first home, but they also go through other life cycle events, and we want to be there to cater to their various insurance needs as they go through those joyous occasions.
So Daniel, following on from that, you can probably see my dog in the background there. He's
well timed.
Throughout the interview. And if there's one thing I could do with after lockdown is probably some therapy for me and him. I think he's like the only one thing I've really struggled with. Because of course we're not going to meetings, we're sitting here, so I'm with him 24/7, seemingly at the moment, and our relationship's getting a little frayed. Anyway, but if that was part of the insurance package, I'm signing up. But I had a question. So what's that? Sorry.
No, I'm making a note of that.
Yeah, do say yeah. So pet therapy, I think we can put it under. with auto insurers paying back a bunch of money, so my car's sitting on the drive doing nothing for months, and all the rest, we're all spending so much time at home. Have you seen a knock-on for yourselves around claims and any sort of bizarre and unusual sort of maybe patterns or unforeseens that you've experienced as a business?
Nothing too exotic. We do every now and again see dramatic claims, but not ones that I can attribute directly to the COVID or to the lockdown. And I'm not sure that we entirely know what the dynamic is going to look like quite yet. So in broad strokes, homeowners insurance has seen a modest decline in claims, nothing like car insurance. But at the same time, a fair number of people have fled the city to wherever it is that they flee. I think a lot of apartments are empty at the moment, and we'll see what happens when they come back. So we're kind of waiting to see how this all comes out in the wash. But so far, broad strokes, our business has been kind of business as usual. And obviously that's in stark contrast to many areas of insurance, which either like car insurance have kind of swung wildly one way, or if you had the misfortune of insuring the Olympics, or business continuity, as AXA just discovered in France or other places, that's obviously swung way the other way. We're seeing our business has continued, and most of our key metrics have continued to progress in a way that if we didn't know that the pandemic and lockdown was going on, you wouldn't know it looking at our numbers.
I'll ask Daniel over that you've obviously quite famous in your give back, but you've switched the give back to direct relief. How has that gone during the COVID-19?
That's great. We didn't do a wholesale switch. We offered our customers if they would like to switch. So this was really a customer-driven choice. And something like, if memory serves, 40 or 50,000 customers made that switch. We will be publishing, our Give Back Day is July 1st. So we'll be publishing our numbers on the Give Back quite shortly, and then you'll get to see the real numbers and the full impact. But it's been a big deal. It's been a big deal, and we were really pleased, and I think our community at large felt very good that we were able to leverage our business to try and do our share, and that's really all it is. Everyone does their little bit to try and move the process forward.
Yeah. I suppose you touched upon it with the kind of use the paying the claim, but looking back at the history of Lemonade and the wider Insurtech space, have they evolved as you'd expect together, so to speak?
I'm not sure they have. I've been a little bit surprised, with mixed feelings, not to see more full stack insurance companies, particularly in the US. And I understand that the regulatory hurdles there and the surplus hurdles are having, developed all the scar tissue for all the things that it takes to get there. I certainly have respect for the challenges. But had you asked me X years ago, would we see much more fierce competition from other companies who understand the power of building this from scratch on a digital substrate, etc., I would have been sure that the answer is yes. And as I look around the landscape today, there are some great Insurtech companies out there, but I would have expected more. I would have expected more that do the full vertical integration rather than being MGAs and fronting for other, legacy insurance companies. And this is such a vast industry that there's opportunity to do so many different things and add value in so many different ways. But that particular aspect of it has been a surprise to me. I still think there's opportunities out there. I think that insurance remains the largest disruptable industry out there. And given that that is the case, I'm surprised that not more people have flocked to try and take a run at it.
Daniel, have you looked at, you've created the digital substrate. Have you looked at licensing that out to others? Have you explored that for your business?
No, is the kind of the monosyllabic answer. We have built that, but we think that the true power is in the integrated system. The business model, the give back, the way we train our humans, the way they complement the bots, and how each of those systems feed in and are fed by each of them. So every Maya interaction, every Jim interaction, every time our AI handles a support inquiry, it is every marketing campaign, all of those are generating tons of data. We've got over 2 billion data points that we've collected so far. So constantly being enriched, but also constantly enriching each of those interactions. And I think just taking out this system that pays claims in isolation from all of that is missing the true power. It's really a system, an organism where with aligned interests and with charity, all of these components interplaying and hopefully increasingly being fine-tuned one with the other. So, no.
I have to ask, Daniel, obviously there's been a lot of speculation about an on-off IPO with Lemonade over the last 12 months. Could you shed some light on the truth here?
Well, I've not ever commented on our future fundraising or IPO, and I won't do that now either. I will tell you that I am predisposed, without telling you anything about Lemonade, just to share with you kind of my thinking about this. I think younger IPOs are good. I look at the class of 2019 and see how the dynamics have evolved in the tech industry, nothing to do with the Insurtech industry. And I'm not sure that the delay of IPOs has really been good to anybody, investors or the companies themselves. In the late 90s, companies like Amazon and shortly after that, Google and Microsoft back in the day, when they went public, they were like 4 years old and did $100 million of business. And 10 years later, it was 14 years old was the average. So there's been this kind of protracted adolescence, this delayed adolescence, if you like. And just like delayed adolescence with humans isn't necessarily a wonderful thing, I'm not sure it does all that much good for the long-term development and health of companies. Now, it's been fueled by an abundance of capital. You can raise huge amounts of money at better valuations with less scrutiny than you'll get in the public markets. It's very tempting to remain in the cocoon. But as I say, if you think about building something for the next 20 years, and you ask yourself not what will be nicer, better, cheaper for the next 12 months, but what is the best platform to build an enduring, valuable business that will last the test, stand the test of time. I do think that militates in favor of taking your pain early and growing in that environment. And in general, some of these companies that did go public in 2019, they did all of their growth in the private markets. They heaved themselves onto the public markets at already a fairly mature kind of state. And the investors threw up all over that, didn't approve of that. And then you lose the power that Amazon had and others had, which is that they went early enough to be able to reward investors with their growth, which allowed them to go back to the markets for more capital to fund more growth. And that created a virtuous cycle that has propelled those companies for decades. So for all of those reasons, I am predisposed to look favorably upon younger rather than older kind of age of an IPO.
Interesting. Daniel, last question from me. So first of all, huge congratulations as the number one Insurtech in the Insurtech 100. So well done, you guys. We've touched on this a little bit as to the kind of European market, but as Lemonade in its entirety, what's next? What's next for the business?
We hope to continue to progress along each of the trajectories that we think of. So geographic expansion is one. So there's no question that more countries, more states, more geographies as someone would like to go. It is kind of striking, but I mentioned earlier that we launched in Germany, our first European foray, and we have 0 employees on the ground there. But even in the US, our two largest markets are Texas and California, and we have 0 employees in either of those states. So again, coming back to this alternative substrate and alternative way of doing things, that militates in favor of being able to grow fast over a geographic expanse, because the traditional mode of coming into town, building the skyscraper and putting 10,000 people in it inhibits geographic expansion, and we're not inhibited in the same way. And if we launch in a country and it doesn't work out, that's okay, because it's not a bet the company moves. So we can be much more experimentalist and move faster. And sometimes the best market research is just to do it and find out from the market rather than analyze. So that's one. The same philosophy is guiding us along product launches. So we mentioned Pet, and we've been public about the fact that we will launch Pet soon. We're still being cagey about what comes after that, but we are working on future products. So that's another one. And then you have to continue to build down deep. So some of that kind of 90% of the iceberg that's submerged. When you're more than doubling your business year on year, you're hiring a lot of people, you're creating new tools, new infrastructures, new products. You constantly want to be able to have enough resources to invest in that infrastructure to make sure that you're not cutting corners. That, yes, as you rightly pointed out, Matt, as your business grows, delight grows faster, loss ratio declines faster. We never want to be in a situation where we're selling dollars for 90 cents, where our growth is being funded by bad business practices or at the expense of customer satisfaction. And that requires a fair amount of inwardly focused innovation as well.
Okay, Daniel, well, thank you very much for your time. We're about to run out of the allotted 40-minute Zoom. I always go for the 40-minute Zoom to make sure these podcasts are kind of a decent length. But thanks very much for your time, Daniel. And obviously, thank you very much, Matt. If you'd like to read more about the Insurtech 100, then please check out posts online and I'd say in print, but mostly online and in app at the moment. And also, if you want to subscribe to either Insurance Age or Insurance Post, then please use the tab at the top. But until the next Insurance COVID cast, stay safe, and it's goodbye from me. Cheerio, everybody.